So I'm sorry about the impromptu look and nature of this video. I'm currently sitting in London Heathrow Airport. Charity and I are on our anniversary trip. Our anniversary is in January, but we're taking the trip in April because it's a much better time of year to visit the UK and Ireland. And we're currently getting ready to go get on our flight to Ireland here in just a couple hours. So if you hear some background noise, that's what's going on. That's where I am. But I felt like with what happened this week in the market, I think there's a lot of you that have concerns, and I just wanted to share my thoughts via video format. And if you say, what happened in the market this week? Well, then good for you, because these will be good reminders, but it probably not as timely for you. But really, what I wanted to just tell you is really three things. Anytime something like this happens, and of course, just to catch up to speed if you're not already aware of what we're talking about, President Trump has been talking about tariffs, and we kind of have this trade war going on between us and pretty much the rest of the world, it seems like, and it's changing on a pretty daily and sometimes hourly basis, so new news comes in. But this week, as some tariffs were set to be going into place, several countries retaliated with their own tariffs, and of course this is going to lead to a lot of pain in the short term because prices for lots and lots of things that all of us use on a regular basis are about to go up. And in response to that, the stock market dropped 2 days in a row. Thursday was really bad. Friday was also really bad. And so it ended a couple bad days to a bad week to a bad start of 2025. So what should we keep in mind? I just want to tell you three things, three reminders in a situation like this. Number one is this: it is okay to feel concerned. You know, when I watch a lot of the news, I get concerned too. I think it's just a natural human feeling to wonder what the future is going to hold, especially when things that are unexpected events change the status quo. We've had a lot of market downturns in the past 125-ish years of the stock market, and those have been for many different reasons. And it seems like it's been a different reason almost every single time. But we have not had a trade war over tariffs in about 100 years. And it's interesting because back in 2020, it was the first time in about 100 years that we had faced a global pandemic. And that, I don't know about you, but that felt a lot scarier in 2020 than whatever this is, at least so far. But we got through 2020. We got through 2022, the market downturn there. We got through the great financial crisis in 2008. We got through the tech bubble in the early 2000s. And we've gotten through every other market scare so far. Well, how? And this leads me to the second reminder. We need to use the past to help us navigate the future. When things like this happen, we've got to use the lessons that we've learned in previous market downturns to help us get us through the current one. And here's what we've learned time and time again. Even though the reasons for market downturns change, how they shake out in the end has been pretty much the same every single time. And here's what we've learned. Doing things like trying to time the market almost always does not work. And what I mean by that is saying, stocks are down right now, stock market is scary, let's get our money out of stocks, let's put it in cash, let's put it in bonds, and let's leave it there until things improve. And that sounds great, but there are two really big issues with this. Number one, we don't know if the market will continue to go down, because the market is only down so far. When we say things like the market is going down, there's almost like an implication. We're implying that it has further to fall, but we don't know that. We don't know where the bottom might be. And when the market does rebound, it rebounds very quickly, and it does not give you very much time or response to get back in and miss out on those really big gains. So the problem with that is, when should we get out? We don't know when the bottom is. And when should we get back in? The market comes back very quickly, and it's very easy to miss that rebound. Also, what do we know from the past? We know that this is pretty normal. Actually, it is not pretty normal, it is normal. The market has dropped more than 10% once a year on average. And it has dropped more than 20% once about every 4 years on average. So even with the last couple of days, we're still not there yet with the US stock market. It's still not down quite 20% from its previous high, but we are getting close. And maybe this next week we do pass through that, maybe not. But in other words, here's what I'm trying to say. History tells us that times like this are normal. They've happened a lot, and it is to be expected if you're going to be in the market for any period of time. So this is why being diversified is so important. And I've been saying this for a couple of years now. All of my clients know this. We want to have a significant percentage of our money in international stocks because we know that the US stock market will not always be dominant like it has been for the last 10 to 15 years. And for those with more conservative portfolios, we've been talking about having a significant portion of your money in bonds, people that are closer to retirement. So here's a good here's a good example of how this has played out. So year to date, as I looked at it today, the S&P 500, which is the 500 largest stocks in the US, are down about 13.5%. Not great. But meanwhile, the MSCI World Index, which tracks international stocks, is only down 5.8%. Not great, but still a lot better than the US. But the AGG Bond Index Fund is up 3.2%. The Fidelity Real Estate Index Fund is down only 0.3% for the year. The DBC Commodity Index Fund up 1.6% for the year. So if you have a portfolio that's diversified into multiple different types of investments, your whole portfolio is not down 13.5%. The only way that that's happening is if you've got all of your money in large US stocks. And that, as I've been saying for a long time now, is not a good idea. That's why you want to diversify. Now, please understand, when I say that, I'm not saying, here's what you need to invest in, here's how much. I'm just giving you a for instance, and it illustrates the power of diversification and how it plays in situations like this. Perspective is really, really key. Gotta have perspective. When you look at the last 3 months in the market, things look scary. When you look at the last 3 years, the market actually looks pretty good. But when you look at the last 3 decades, it looks great. So always zoom out. Remember, this is not something we're doing for the next 3 months or the next year or even next 3 years. This is something we're doing for a long period of time. But the third reminder I want to give you is this. We've got to focus on things that we can do right now. What can I do right now that's helpful? I cannot control the market. I cannot control tariffs. I cannot control interest rates or any of the rest of that goes on in Washington, D.C. or on a macroeconomic level, but I can control some things. So for instance, I can control how much I'm investing. If you're thinking about investing more money this year, well, guess what? Everything is on sale. Studies have consistently shown that if you're thinking about investing a lump sum of money, it's better to do it immediately instead of spreading it out over time. That usually leads to a better result. This is especially true now that the market has dropped and all of the same companies that you would have invested in 3 months ago are now significantly cheaper. But even if you don't have extra money to invest, this is why it's good to periodically rebalance. One of the things that we do for our clients is make sure when we set an investment mix, we set our target percentages, we make sure that those stay at those percentages. So when things are volatile and some things are up and some things are down, when stock funds are down, what are we doing? We're looking at selling from other funds that have done relatively well, or at least better, and then buying the funds that are down so that we can sell high and buy low, right? But even other things like tax loss harvesting. If you have investments in a taxable account, we can look at potentially selling those funds that are down right now, lock in a loss, use that to offset gains and help save you money on taxes. But the last thing I would say is right now is a great time to revisit your financial plan. If you haven't already booked a spring review meeting, please go ahead and do that. We'll make sure that we talk about your goals, make sure we're still on track, and look at things that may be affected or not affected by this recent market downturn. But these are always good times and good reminders for us to review the whole picture and look at all of it, not just the investments. So I hope that's helpful. If you have any questions or thoughts or concerns, of course, I'm always available, but I felt like I should make a little video for you, try to distill my thoughts in a few minutes, and I hope that was helpful. All right, have a great day.